Right now, most people believe the housing market is stable. Some even think the worst is already over. Prices look high, listings look tight, and headlines keep repeating the same comforting message: housing is cooling, not crashing. But that surface level calm is exactly what makes this moment dangerous. Because the biggest market shifts never happen when everyone is screaming panic. They happen when people feel just safe enough to stop asking hard questions. Let me start with something uncomfortable. Housing does not crash when people expect it to crash. It crashes when confidence quietly breaks. Not all at once, not with sirens, but through small cracks that most people ignore until they connect into something much larger. That process has already started. This video is not about fear. It is about mechanics. It is about how housing markets actually turn, why the signals are subtle at first, and why by the time the public narrative changes, the damage is already done. If you are waiting for a dramatic headline that says, "Housing crash begins today," you will be late. The market never gives you that courtesy. Here's the core problem. Housing is not just shelter. It is leverage layered on psychology. It depends on credit conditions, buyer confidence, income stability, and the belief that tomorrow will look like yesterday. When even one of those pillars weakens, prices stop rising. When several weaken together, liquidity disappears. And when liquidity disappears, prices do not fall slowly, they gap down. Right now, we are seeing something unusual. Prices in many regions are still elevated, yet transactions are drying up. Homes are sitting longer. Sellers are cutting prices quietly. Buyers are hesitating, not because they don't want homes, but because affordability has collapsed. That disconnect, high prices with low volume, is not strength. It is fragility. Think about how housing actually works. Unlike stocks, houses do not trade every second. They rely on motivated buyers and motivated sellers meeting at the same time. When buyers step back, sellers can pretend nothing is wrong for a while. They list higher, they wait, they rationalize. But eventually, life forces decisions: job changes, debt pressure, divorce, taxes, adjustable rates resetting. When sellers need liquidity and buyers are scarce, prices adjust fast. What makes this cycle different is how long distortion has been allowed to build. Years of ultra-low rates pulled future demand into the present. Buyers who would have purchased later were forced to buy early at higher prices with more leverage. That demand has now been exhausted. You cannot pull demand forward forever without paying the price later. At the same time, affordability is near historic lows. Mortgage payments relative to income are stretched. Insurance costs are rising. Property taxes are rising. Maintenance costs are rising. The cost of owning a home is increasing even if prices stay flat. That means the break-even point for buyers keeps moving higher, while wages struggle to keep up. And here is the most dangerous part. Most homeowners are anchored to peak prices. They are mentally attached to what their neighbor got last year, or what Zillow still suggests today. Anchoring is a powerful psychological trap. It delays selling, it reduces flexibility, and when reality finally forces a reset, the adjustment is not gentle. Wall Street understands this dynamic better than the public. Institutions do not need prices to collapse to change behavior. They only need risk-adjusted returns to deteriorate. When rental yields compress, financing tightens, and price appreciation slows, capital rotates away, quietly, methodically, long before headlines catch up. You can already see this in subtle data points: investor purchases slowing, new construction incentives rising, builders offering rate buydowns instead of price cuts to preserve optics. These are not signs of strength. They are signs of a market trying to defend price levels in the face of weakening demand. And let me be clear about something. Housing crashes are not caused by one thing. Not rates alone, not unemployment alone, not supply alone. They happen when multiple pressures overlap: tight credit, weak affordability, stretched valuations, psychological exhaustion. We do not need a 2008 style collapse to see meaningful downside. Markets adjust to new realities, even without a single dramatic catalyst. The reason this forecast matters now is timing. Housing cycles move slowly, then suddenly. Most people only react during the sudden part. By then, options are limited, prices have adjusted, lending standards tighten further, opportunity disappears. Preparation is what creates advantage, not prediction after the fact. Over the next parts of this video, I am going to walk you through the exact forces that are converging beneath the surface. Not speculation, not hype. Mechanics. We will talk about affordability math, credit conditions, buyer psychology, inventory behavior, and why regional outcomes will diverge sharply. Some areas will feel pain faster, others will lag, but the direction of pressure is becoming clearer. This is not about calling a top for clicks. This is about understanding how housing markets actually unwind when the narrative stays positive but the math no longer works. The most dangerous phase of any bubble is the one where people believe stability has returned while leverage and fragility remain. So here is the question you should keep in mind as we move forward. If housing is truly stable, why does it require constant reassurance? Why do incentives keep growing? Why are buyers hesitating even as sellers insist prices are fair? Markets that are healthy do not need to convince participants to believe. In the next part, we are going to break down affordability, not with vague charts, but with real-world math, numbers that explain why demand is quietly cracking, even without panic. This is where the story becomes uncomfortable, because it forces us to confront what buyers can actually afford, not what sellers hope for. Stay with me, because once you see the numbers clearly, it becomes very hard to understand where this market is heading. To understand why the housing market is under pressure, you have to forget headlines and look at math. Housing does not move on opinions, it moves on monthly payments. If buyers cannot carry the payment, demand disappears, no matter how strong the narrative sounds. Let us start with the simplest truth. Most buyers do not buy a house, they buy a mortgage. The price only matters insofar as it translates into a monthly obligation. And right now, that obligation has reached a level that is quietly choking demand. Over the past few years, home prices surged while interest rates stayed artificially low. That combination masked risk. Buyers stretched because the payment still felt manageable. But when rates rose, the illusion broke. A house that cost the same suddenly required hundreds or even thousands more per month. Nothing about the property changed. Only the cost of money did. That shift alone rewired the market. Here is where it gets uncomfortable. In many areas, mortgage payments on the same home are now 40 to 60% higher than they were just a few years ago. Wages did not rise at anything close to that pace. That gap is the affordability crisis. It's not emotional, it's arithmetic. People like to say, buyers will adjust. They will put more down. They will buy smaller homes. They will move farther out. That logic only works to a point. Down payments are limited by savings. Smaller homes still face high per square foot prices. Moving farther out increases transportation and lifestyle costs. Every adjustment has a ceiling. What happens when buyers hit that ceiling is subtle but powerful. They pause. They wait. They delay major decisions. That pause does not show up as panic. It shows up as fewer offers, longer days on market, and sellers quietly negotiating behind the scenes. Affordability pressure also changes buyer psychology. When payments feel stretched, buyers become defensive. They demand concessions. They ask for repairs. They walk away over small issues. That behavior signals weakness, even if prices haven't officially dropped yet. The tone of the market shifts before the numbers do. Now layer in the hidden costs that many people ignore. Property taxes have risen alongside valuations. Insurance premiums are climbing, especially in risk-prone regions. Maintenance costs are up due to labor and material inflation. These expenses hit homeowners every month, not just at closing. When buyers run the full cost calculation, many realize the lifestyle trade-off is no longer worth it. This is where sellers misread the market. They assume buyers who step back are simply waiting for rates to fall. But demand destroyed by affordability is not the same as delayed demand. Some buyers age out, some take on other obligations, some accept renting long term, some give up entirely. That demand does not magically return. Investors feel this pressure first. Rental yields compress when prices rise faster than rents. Financing costs eat into cash flow. Appreciation slows. Suddenly, the risk no longer justifies the capital. Investors do not panic sell. They stop buying. That alone removes a major support pillar from the market. Builders understand affordability better than anyone. Watch what they do, not what they say. When builders offer rate buydowns, closing credits, free upgrades, and incentives, it's not generosity, it's math. They know buyers cannot qualify at current rates and prices. Instead of pricing publicly and resetting comps, they hide discounts inside financing. This tactic delays price discovery, but it does not prevent it. Incentives are a form of price reduction. They just don't show up cleanly in headline data. Over time, they train buyers to expect concessions, which weakens pricing power even further. Another key signal is qualification failure. More buyers are being approved for less than they expected. Debt-to-income ratios are stretched. Lenders tighten quietly. Credit does not vanish overnight. It narrows. That narrowing filters out marginal buyers first, then increasingly stronger ones as conditions persist. And here's the dangerous feedback loop. Lower affordability reduces demand. Lower demand increases time on market. Longer time on market weakens seller confidence. Weak confidence leads to price cuts. Price cuts change buyer expectations. Once buyers expect lower prices tomorrow, they delay even more. That loop feeds on itself. This does not require mass unemployment. It does not require forced selling. It only requires buyers to step back long enough for liquidity to dry up. Housing is extremely sensitive to liquidity. When transactions slow, price discovery accelerates. Regional differences matter here. Markets that ran hardest during the boom are the most exposed. Areas dependent on remote work, investor demand, or speculative buying face sharper adjustments. Stable markets with strong local incomes may hold up longer, but they are not immune to national affordability constraints. The key takeaway from this part is simple. Affordability is not stretched. It is broken in many places, and broken affordability does not heal quickly. It requires either lower prices, lower rates, or significantly higher incomes. None of those adjust easily or quickly. In the next part, we are going to talk about inventory and psychology, why supply can rise even when listings appear low, and how sentiment shifts create sudden air pockets in housing markets. This is where slow pressure turns into visible movement. If you understand affordability, you already see the problem. What comes next explains how that problem spreads. Housing crashes are never announced in advance. They unfold quietly, then suddenly. By the time headlines confirm what is happening, the real move is already underway. Part 3 is about that transition, the moment when pressure turns into motion, driven not just by numbers alone, but by human behavior. Most people think housing crashes happen because there are too many homes for sale. That is only half true. What actually matters is effective inventory, not just how many homes are listed, but how many sellers are competing for a shrinking pool of buyers. Right now, many markets still show historically low inventory. This is why casual observers believe prices are safe. But inventory is not static. It reacts to psychology, and psychology is shifting. Let us start with the lock-in effect. Millions of homeowners have ultra-low mortgage rates. This has kept supply artificially tight because selling means giving up cheap financing. For a while, that worked as a price floor, but lock-in is not permanent. Life eventually forces movement. Job changes happen, divorces happen, deaths happen, financial stress builds, adjustable rate loans reset, property taxes rise, insurance spikes. When monthly costs creep higher, low rates stop feeling like protection, they start feeling like handcuffs. This is where supply begins to leak into the market. Not all at once, one listing here, another there. But each new listing enters a weaker demand environment than the one before it. That matters. Now consider investor-owned properties. These are not emotional assets. They are numbers on a spreadsheet. When returns compress and appreciation slows, investors reassess quickly. They do not wait for headlines. They reduce exposure when risk-adjusted returns no longer make sense. Some sell immediately, others stop buying and let listings pile up. Either way, investor demand fades before owner-occupier demand does. This removes a key buyer group that supported prices during the run-up. Then there is the shadow inventory, homes that are not listed yet but will be, short-term rentals that no longer cash flow, new builds nearing completion with fewer qualified buyers, homeowners who want to sell but are waiting for a better moment. Shadow inventory does not show up in official data until sentiment changes. And sentiment is changing. Buyers are no longer afraid of missing out. That is the most important shift. Fear of missing out drives bubbles. Fear of overpaying ends them. Once buyers believe prices could be lower in 6 or 12 months, urgency disappears. You can see this in behavior. Buyers take longer to decide. They make lower offers. They walk away during inspection. They refuse bidding wars. This behavior forces sellers to compete, even if inventory numbers look tight on paper. Sellers respond emotionally at first. They anchor to peak prices. They blame seasonality. They wait. But time is not neutral in a slow market. Every extra day on market signals weakness. Buyers see it. Agents see it. Algorithms see it. Price cuts begin quietly. First 5%, then incentives, then relisting at a lower number. Each cut resets expectations for the next seller. Comparable sales lag reality, but psychology moves faster than data. Here's where markets tip. Once sellers believe waiting will cost them money, supply accelerates. Not because everyone panics, but because patience runs out. That's when inventory rises quickly, even without a construction boom. Media plays a delayed but powerful role. Early on, coverage stays optimistic. Soft landing narratives dominate. But once price declines show up in enough markets, tone shifts. Articles start using words like cooling, correction, then downturn. That change alone affects buyer behavior. Housing is reflexive. Beliefs shape outcomes. If enough people believe prices are falling, they act in ways that make it true. That is not emotion, that is coordination. Another overlooked factor is transaction volume. Prices do not need to collapse for damage to spread. When transactions fall sharply, industries tied to housing feel it. Agents, lenders, contractors, inspectors, movers. As income in these sectors drops, local economies feel pressure. That pressure feeds back into housing demand. This is how housing downturns broaden, not through one dramatic trigger, but through cascading second-order effects. Lower turnover reduces income. Lower income reduces demand. Reduced demand increases inventory. Increased inventory pressures prices. Geography matters here. Some markets will crack earlier than others. Places with high investor concentration, stretched affordability, or reliance on variable income are most vulnerable. Others will lag, then follow. It is important to understand what this is not. This is not necessarily a replay of 2008. Lending standards are different, but cycles do not require the same cause to produce similar effects. All they need is imbalance and reversal. Right now, the imbalance is between prices and purchasing power. The reversal is happening through psychology and liquidity, not defaults. That makes it harder to spot early, but no less real. When analysts say housing cannot crash because there is no forced selling, they misunderstand markets. Prices move at the margin. They are set by the next transaction, not the average homeowner. If the marginal buyer steps away, prices adjust downward to find them again. By the time forced selling appears, if it appears at all, prices have already moved. This part matters because it explains why housing downturns feel slow then fast. why data lags reality, why people are surprised even though signals were everywhere. In the next and final part, we will talk about what comes next: scenarios, timelines, and how different groups are likely to be affected. Not predictions carved in stone, but frameworks to think clearly while others react emotionally. If you understand inventory and psychology, you are no longer guessing. You are watching the system shift in real time. By now, the picture should be clearer. Housing does not crash in a single moment, it transitions. And once that transition is underway, outcomes depend less on hope and more on positioning. This final part is about what likely comes next, how long it could take, and how different groups are affected. Not fear-based predictions, clear frameworks. Let us start with timing. Housing moves slower than stocks, but faster than most people expect once momentum flips. Prices usually peak first, volume collapses next, then price declines spread from overheated markets to more stable ones. Historically, once affordability breaks and demand stalls, it takes 12 to 24 months for the full effect to show up in prices nationally. Some cities lead by a year, others lag, but the direction matters more than the exact date. The key point is this: housing downturns are processes, not events. Waiting for a headline that says crash confirmed usually means you're late. Now let's talk scenarios. The first scenario is the slow grind. Prices drift down 5 to 10% in real terms over time, masked by inflation. Nominal prices look flat, but purchasing power erodes. This hurts sellers quietly and rewards patient buyers. The second scenario is the regional break. Investor-heavy markets, short-term rental hubs, and affordability extremes see sharper declines. 10 to 20% drops are possible there, while national averages stay moderate. This creates the illusion that nothing serious is happening, until it is. The third scenario is a macro shock overlay. Rising unemployment, credit tightening, or a financial accident accelerates everything. This is when psychology flips fully. This is rare, but it's always the reason people later say it happened faster than expected. None of these scenarios require reckless lending or mass defaults at the start. They require only that buyers step back and sellers blink. Now, let us break this down by group. For homeowners, especially those who bought recently, the biggest risk is not losing the home, it is being trapped. If prices fall below purchase levels and selling becomes costly, mobility disappears. This affects job choices, lifestyle decisions, and financial flexibility. For long-term owners with low rates, the situation is different. They may see paper losses, but cash flow remains stable. The risk for them is complacency. Rising taxes, insurance, and maintenance can quietly change the math over time. For investors, this is where discipline matters. Appreciation-driven strategies are fragile in this environment. Cash flow assumptions must be stress-tested. Vacancy rates matter more than projected rent growth. Liquidity matters more than leverage. The investors who survive downturns are not the most aggressive, they are the most adaptable. For buyers waiting on the sidelines, patience is an asset, but only if paired with preparation. Credit readiness, down payment flexibility, and market knowledge matter. The goal is not to call the bottom. The goal is to buy when leverage shifts back toward the buyer. And that shift always comes quietly first. Longer days on market, fewer competing offers, sellers offering concessions. Those are signals, not headlines. For policymakers and lenders, the challenge is credibility. If rates stay high while affordability worsens, pressure builds. If rates fall too fast, inflation risks return. This tension limits how much relief housing can expect. Do not assume rescue is guaranteed. Markets often move further than policymakers intend before intervention changes behavior. Now, let us address the biggest misconception. People think housing crashes are about homes. They are not. They are about liquidity, about who can act, who cannot, and who must. When liquidity tightens, prices adjust to find it again. This is why cash buyers gain power in downturns, why financing terms become weapons, why sellers eventually compete on price instead of hope. If there's one lesson from every housing cycle, it is this: the best decisions are made before emotions peak, before fear dominates, before optimism returns. This is not about panic, it is about clarity. If you own, understand your true costs and your time horizon. If you invest, reassess your assumptions honestly. If you plan to buy, focus less on forecasts and more on conditions. Housing will not announce the moment it turns, it never does, but the signals are already visible if you know where to look. Affordability stretched, demand fragile, psychology shifting, inventory waiting for a catalyst. The question is not whether housing changes from here, it already has. The real question is whether you react late or prepare early. That difference determines outcomes, and that is what Wall Street rarely tells you. Let us bring everything together. Housing markets do not collapse because everyone suddenly agrees prices are too high. They shift because behavior changes quietly, then all at once. Buyers hesitate, sellers resist, transactions slow, liquidity dries up, and price becomes the only lever left to pull. What makes this moment different is not panic, it's fragility. Affordability is stretched to extremes. Monthly payments sit far above historical norms. Wage growth has slowed, consumer savings are thinner, and expectations are still anchored to a world of cheap money that no longer exists. This is how cycles turn, not with chaos at first, but with disappointment. Most people are still emotionally anchored to peak prices. Sellers believe their home is special. Buyers hope rates will save them. Investors assume rents will always rise. Each group is waiting for confirmation from the market instead of reading the signals already present. That gap between expectation and reality is where corrections are born. The smartest move right now is not prediction, it's preparation. Stop asking, will housing crash? Start asking, what conditions would force people to act? Job loss, rising carrying costs, liquidity pressure, time. Those are the real drivers, and they are slowly lining up. If you're a homeowner, your advantage is time. Use it wisely. Know your numbers. Understand your break-even point. Do not rely on headlines to guide decisions that affect years of your life. If you're an investor, this is a season for humility. Rerun your models, stress test your assumptions, focus on survival before growth. Cycles reward those who stay in the game long enough to capitalize on the next phase.